It's the first Friday of the month, but it's non-jobs day as the US government shutdown enters its fourth day, leaving the markets finishing the week in a bit of an anticlimax. Joining me down the line to share his insights is Nick Stamenkovic. Nick, the NFP report has become the latest casualty in the government standoff. But what's next? Do you really think it can continue until the debt ceiling deadline? Just how far-reaching would those repercussions be?
Well, clearly the political situation is a state of flux, but both sides, both Republicans and Democrats, show a few signs of budging from their entrenched positions. On the one hand, the Republicans are arguing that Obamacare should be rolled back a year. That is being firmly rejected by the Democrats, and Mr. Obama made it quite clear he's not prepared to accept it. So it looks as though we're moving closer and closer to the brink of the debt limit being breached. Clearly, there's a couple of weeks before we get to that level or to that time. But at the moment, there's no signs of any compromise on the table. Hopefully, politicians will see sense and realise the dangers of what they're potentially doing, and I think eventually that will happen. And at the moment, the market's clearly giving the benefit of the doubt. But the closer you get to the debt limit, the more the markets will get nervous, and the more investors will get concerned that something more serious could happen with significant ramifications to the US economy.
US initial jobless claims came in at 308,000, pretty much unchanged from the prior week's 307,000, but below expectations of 315,000. What would you have expected from today's report? Has the ADP report been given more clout as a result of today's delay?
Well, the weekly jobs claims are very volatile from week to week, and they've been affected by technical factors recently, though that's now starting to unwind. It's better to look at the full-week moving average, which gives you a better underlying picture of the trend, and that's clearly been trending down. So it clearly shows that fewer companies actually laying off workers, which is encouraging. But what the ADP employment report showed was, on the other side, companies still remain reluctant to hire. And recently, ADP employment reports had quite a good correlation with non-farm payrolls. So it certainly doesn't suggest that the labour market is strengthening significantly. If anything, it suggests that labour market hiring might actually have softened a bit over the last few months. And judging from that, I would expect another modest rise in non-farm payrolls when it's eventually released. And hence I see no rush for the Fed to start tapering QE.
How damaging is this all in terms of credibility for the US, Nick? This is not surely the kind of message they want to be giving to partners or competitors, for example, like China.
Yes, certainly. I mean, clearly, as I mentioned earlier, there are clear political viewpoints which are being adhered to. You have the Tea Party on the right, which is very anti what Mr. Obama's been trying to do, particularly on healthcare, and they're not showing any signs of changing their position. And Mr. Obama, on the other hand, as I mentioned, doesn't seem to want to negotiate on anything that, in his view, has already been passed. So I think it clearly doesn't send a positive message to other countries, and as you've seen, investors have certainly turned against the US dollar, at least for the time being, though the US government bond market remains pretty well underpinned because of its safe haven status and the high level of liquidity. But the longer this goes on, the more protracted it is, and the closer it gets to the US debt limit, the more investors will get concerned, and more the credibility of US fiscal policy come under the microscope.
When the unemployment levels were deemed so integral to the Fed's taper plan, the last figure was more indicative of people getting out of the employment search. The markets have been so far unaffected by the shutdown. Could this be the thing which finally grabs their attention?
Well, I think it's important to stress that the Fed seems to change its reaction function, i.e. what they follow in setting monetary policy. And when Mr. Bernanke spoke in mid-May, first mentioned tapering QE, he associated end of QE with the unemployment rate reaching a threshold of 7%. But in his latest press conference after the September FOMC meeting, there was no such comment. If anything, the Fed seems to be looking at a broader set of indicators, particularly in the labour market, but growth as a whole. And that was very much reinforced by the New York Fed President, Mr. William Dudley. So the market's clearly been much more sensitive, not just to employment data and the non-farm payrolls in particular, but data as a whole. And I think until the Fed is convinced that the labour market is showing significant signs of improvement and growth as a whole is improving, they're going to be very reluctant to start the tapering process. So the earliest I can see the Fed cutting back its central bank asset purchases will probably be December's meeting, and I wouldn't rule out a delay to early 2014.
Nick, would you say the Fed has been inflationary or deflationary in their actions?
Well, I think looking at the Fed's reaction or the Fed's policy under the guise of Mr. Bernanke, clearly they've wanted to take action to rule out any possibility of deflation. Mr. Bernanke came out with a very influential paper in the 1990s, which clearly showed his concern of what happened in Japan and the decade-plus long period of deflation they suffer from, and he doesn't want that to be repeated by the US. So the policy has been very much aimed at removing deflation risks in the US economy, keeping the economy above par, whilst containing inflation, but there hasn't been any sort of signal that they're moving away from their dual mandate of stable employment growth and price stability. So I would say, certainly at the moment, the Fed is erring on the side of more pro-growth stance, and that's been reflected in the correction we've seen, particularly in the equity, the rally we've seen in equities post-FOMC until all these fiscal problems came to the fore.
The euro hit 8-month highs against the dollar as we finished the trading week, but what is your outlook for these currencies moving forward? Is the US taking advantage of the dollar being the reserve currency, and could this hurt them in the end?
Well, the dollar's actually weakened, not across the board, but against some of the major G10 currencies, as you mentioned, the euro in particular, an 8-month high, against the pound as well, but against some of the emerging market currencies, it's actually strengthened. So you've seen a mixed performance. I think the significant thing is that prior to the last FOMC meeting, most people are anticipating the Fed to set the broad guidelines for not just an end of QE, but an eventual move to raise interest rates. That clearly now seems to be off the agenda. Hence, a lot of the long positions we've seen dollars start to unwind. So until we see a clearer picture for the Fed and some of the uncertainty over fiscal policy start to ebb, then I think the dollar's going to struggle near term. But going forward, given the US economy is still going to grow at a pretty decent, reasonable pace this year and should accelerate next year, and then eventually a tightening of monetary policy will be back on the agenda, then the dollar should gain some of its losses, particularly against the euro.
Nick, thank you so much. It's a pleasure speaking to you. Well, viewers, that's all from me for the moment. Of course, when the NFP figures are released, we will keep you up to date with results. But in the meantime, take care.